Why do so many intelligent, hardworking people make the same investing mistake over and over again? You see a stock going up fast. Every headline talks about it. Social media is full of success stories. A friend tells you he made 6 months of salary in just a few weeks. Suddenly, doing nothing feels wrong. Waiting feels risky. You start thinking, what if this is my chance? What if I miss it? And just like that, the pressure builds. This is where most investing mistakes begin. Not with lack of knowledge, but with emotion. In behavioral finance, there's something called recency bias. It's a simple idea. We tend to believe that what just happened will keep happening. If the market has been rising for the past year, we assume it will continue rising. If a certain sector has been outperforming, we assume it's the future. Our brains love recent evidence. It feels fresh, it feels convincing, it feels real. But markets don't move in straight lines. They move in cycles. Yet, when prices rise long enough, it stops feeling like a cycle. It starts feeling permanent. We tell ourselves, this time is different. We create stories to justify why the trend will never end, and that's when risk quietly increases. Let me ask you something. Have you ever felt more confident buying an investment after it already went up a lot? And more scared to buy after it dropped? You're not alone. When prices are rising, it feels safe. When prices are falling, it feels dangerous. But often, reality is the opposite. Rising prices can mean higher valuations and higher risk. Falling prices can mean better long-term opportunity. So why do we act against logic? Because we are human. Another powerful force driving trend chasing is FOMO, the fear of missing out. FOMO doesn't feel like fear. It feels like urgency. It feels like excitement. It feels like everyone else is moving forward while you're standing still. You scroll through your phone and see people posting gains. You hear conversations about easy money. You start comparing. And comparison creates pressure. Why didn't I buy earlier? Why am I always late? Should I just jump in now? FOMO is dangerous because it speeds up decision-making. It pushes you to act before thinking clearly. It makes you believe that if you don't move now, you'll regret it forever. But markets are not once-in-a-lifetime events. Trends repeat. Cycles repeat. Opportunities return. The fear that this is my only chance is rarely true. Yet in the moment, it feels completely real. And then there's performance chasing. Performance chasing is when investors look at last year's winners and move their money there. A fund that topped the charts suddenly attracts huge inflows. A sector that delivered massive returns becomes everyone's favorite. It sounds logical. Why not invest in what's working? But here's the catch. By the time performance is obvious, prices already reflect that success. You're not buying before growth. You're buying after it. You're paying for the story when excitement is highest. And what happens when growth slows down, even slightly? Disappointment. The same crowd that rushed in begins to rush out. Markets rotate. Leaders change. Yesterday's star can become tomorrow's laggard. So the cycle repeats. People buy high because it feels safe. They sell low because it feels responsible. And over time, this emotional cycle quietly erodes wealth. Not because they're foolish, but because they're reacting. Let's be honest. Investing would be easy if it were just about information. Data is available. Research is accessible. Financial news runs 24 hours a day. Yet most investors still underperform the very markets they invest in. Why? Because investing is less about intelligence and more about behavior. Your biggest advantage, or your biggest enemy, is your own psychology. Think about market bubbles in history. At the peak, optimism is everywhere. Experts appear confident. Valuations seem justified. Skepticism sounds outdated. Anyone cautious is labeled negative. At the bottom, it's the opposite. Fear dominates. Pessimism feels rational. Good news is ignored. Optimism sounds foolish. The market doesn't just test your knowledge, it tests your emotional stability. So, how do you break free from this pattern? The answer is discipline. A disciplined strategy acts as a filter between your emotions and your money. It creates structure, it sets boundaries, it defines rules in advance, before excitement or fear can interfere. This is where approaches like MPLY come in. MPLY isn't about chasing whatever is trending this month. It's not built on reacting to headlines. It's designed around consistency, balance, and process. Instead of asking, what's hot right now? It asks, what aligns with my long-term framework? That shift in thinking is powerful, because when you operate within a clear structure, you reduce impulsive decisions. You don't have to constantly guess. You don't need to predict the next big thing. You're not jumping from story to story. You follow a system, and systems are calmer than emotions. Imagine waking up and not feeling the urge to check market prices immediately. Imagine hearing about a stock doubling and not feeling pressure. Imagine market volatility happening, and instead of panic, you feel prepared. That's what discipline creates. It doesn't eliminate risk, but it manages behavior. A disciplined approach typically includes diversification. It spreads exposure across assets instead of concentrating everything into the latest trend. It rebalances when allocations drift too far. It respects risk tolerance. It focuses on long-term objectives rather than short-term excitement. It accepts that you won't capture every spike. And that's okay, because the goal isn't to win every race. The goal is to finish strong over decades. Let me ask you another question. Would you rather experience small, steady progress over 20 years, or dramatic highs and painful crashes? Many people say they want stability, but when they see fast gains elsewhere, patience becomes difficult. That's why discipline must be intentional. It must be decided in calm moments, not chaotic ones. MPLY and strategies like it aim to remove the emotional roller coaster. They focus on long-term wealth building rather than short-term thrill-seeking. They acknowledge that markets will rise and fall, but over time, disciplined participation can compound meaningfully. Compounding is not dramatic, it's quiet, it's almost boring, but it's powerful. And here's something important. Discipline doesn't mean ignoring opportunities. It means evaluating them within a structured plan. It means asking, does this fit my allocation? Does this match my risk level? Am I acting from strategy or from excitement? That pause can protect years of progress. Because one impulsive decision during a market frenzy can undo years of patient investing. Trend chasing feels active. It feels smart. It feels like you're doing something. Discipline sometimes feels inactive. It feels slow. It feels like you're missing out. But long-term wealth often grows in that quiet space, where you resist unnecessary action. Markets will always create noise. New technologies will emerge. New industries will boom. There will always be another revolution promising massive gains. And some of those trends will succeed. But chasing them emotionally, without structure, turns investing into speculation. The real question is not whether trends exist. The real question is whether you control your response to them. Recency bias will try to convince you that what's rising will rise forever. FOMO will push you to act quickly. Performance chasing will tempt you to follow last year's winners. And discipline will quietly remind you of your plan. So the next time you feel that rush, that excitement, that urgency, stop for a moment. Ask yourself, am I investing based on evidence and structure? Or am I reacting to emotion? Am I building long-term wealth? Or am I chasing short-term validation? Because in the end, successful investing isn't about being the smartest person in the room. It's about being the most consistent. It's about surviving cycles. It's about staying invested through uncertainty without losing control. It's about understanding that markets reward patience more than excitement. You don't need to catch every wave. You just need to stay in the ocean long enough for the tide to rise. And sometimes, the most powerful move you can make is simply sticking to your strategy when everyone else is chasing the next big thing. So take a breath, zoom out. Choose discipline over impulse. Choose structure over hype. Choose long-term over temporary. Because trends will come and go. But a disciplined strategy like MPLY can help you stay grounded. And that grounding might be the difference between reacting to the market and truly building lasting wealth. Thanks for watching. Don't forget to like and subscribe to our YouTube channel